everyone. Ciao. So, good evening to all present. I, Sanskrithi Jain, would like to welcome you to the fourth edition of Stock the Stock, a flagship event of BFM committee at HR College. Today, we are proud to welcome Mr. Shubham Sanghvi, who is currently working as a financial analyst at Ocean Leonard Investments, London. And he has also worked as a financial service analyst at Ernst& Young when he was in Mumbai. Currently, he is pursuing his MSc in Business and Finance from Warwick Business School, UK. And the list of achievements goes on and on. So when I say that when we are talking about investments in finance, when I say that we are talking about investment in finance, I say when Shubham Sanghvi has a lot to bring to the table, and we'll be hearing it in a while. Before that, I would like to express my heartfelt gratitude to our principal ma'am, Pooja Ramchandani, for giving us all the resources and helping us in making the PFM committee to make a Stock the Stock a very successful event of the year. Next, I would like to thank our course coordinator and teacher in charge, Ms. Shweta Singh ma'am and Vicky Karnani sir, for their constant support and guidance. A special mention to the president and vice president of BFM committee, that is Karishma and Shubham, for making all this happen. With all this being said, I would request Mr. Shubham Sanghvi to take the lead.
Thank you, Sanskriti, for that wonderful introduction. So let's start. I'll
Yes,
just be sharing my screen. Yeah, is it visible to all? If
yes,
someone can just give me a small confirmation.
it's
Yes, it is
visible.
visible.
All right. So I assume that everyone has already completed one session on fundamental analysis. So we will just have a small quick recap, and then we will be working together on a case study today. So let's begin. So before we get into the topic, I was already introduced, but this is just, the same thing mentioned again. So I can skip this now. So first we begin again with what is fundamental analysis. So in accounting and finance, fundamental analysis is basically the method which analysts use to gain the intrinsic value of a security. What do you mean by intrinsic value? What the value, what the stock, it may be a common stock, it may be a bond, it may be an option, it may be a future, but what the value actually should be. And this is something not that happens over a small time period. It is over a long time horizon. Usually it may be after 2 years, it may be after 5 years, but this is what they believe that the value should be. So what are the main objectives of fundamental analysis? The first one is to understand the company's financial health. Is the company earning enough to be able to cover its costs as well as make some profits? Is the company being valued properly? And based on these questions, once we see that, okay, the just give me a second. So based on this, we can make informed investment decisions. If I believe that the cost of a particular common stock should be lesser than what it is today, I will ideally buy it right now. So then when the price increases, I will be able to sell it at a higher price and hence make a profit. Then we move on to financial statements. These are the base of from where the fundamental analysis is carried out. So first we move to balance sheets, then we come to income statements, and then we also analyze cash flow statements. So balance sheets. So balance sheets has three main components. They show us what the company's financial position is at any point of time. So first we begin with current assets. Current assets are all assets that are converted into cash or are used up within a time frame of 1 year. Non-current assets are ones that will last for longer. So if you have your plant, you have property, you have building that will last for one longer than 1 year. So those are your non-current assets. Then we come to liabilities. The same concept applies. Current liabilities are your short-term obligations. If you have to pay a debtor within a year, those come under current liabilities. And non-current liabilities can be something like debentures, long-term loans from banks, etc. The last component is equity. and this is the capital ownership that is held by the shareholders. So this can be in the form of common stock and preferred stock. And the balance sheet will always tie up, the assets will always be equal to the liabilities and plus equity. Next, we come to the income statements. So these are the few key terms. We have revenue, that is the total income from the sales of goods. Then we have cost of goods sold. This is the cost incurred to make the goods available for sale. Then gross profit is calculated by subtracting cost of goods sold from revenue. Then we have operating expenses. These are the costs that are usually incurred for day-to-day operations. It can be rent, it can be daily wages, etc. Operating profit, that is the income surplus after considering all the costs. So my revenue is there, and then I have my cost of goods sold, I have my operating expenses, and the profit that still remains after that is my operating profit. Other income and expenses, it is a generalized bracket where we take into consideration all incomes and all costs that do not come under the above categories. And then finally, we have the net income. That is the overall gain or loss that after taking into consideration all the revenues and expenses. Next, we come to the cash flow. Now, cash flow is one of the most transparent financial statements of a company because it exactly shows us that this is the amount of cash a company has for its day-to-day activities or even for its long-term activities. So first we come to operating activities. That is the first out of the three main components of a cash flow. So these relate to all the core business operations. So if you are paying a customer, if you have to return, if there's a sales return, so if you're paying the customer, if you are receiving income from the customers, all these come under operating activities. The second is investing activities. These involve transactions which are for long-term assets. So if you pay in cash for a building, or if you buy a machine which you know is going to last for maybe 5 years, so these will come under investing activities. And lastly, we have financing activities. These are the cash transactions which include the company's owners and creditors. So these include buying stock, buying debentures, reissuing any of the stock, etc. So with this, we come to the ratio analysis. This is the main basis from where the analyst can find out whether the stock is a good uh, has a good has a good value or not. So first we come to the liquidity ratios. Liquidity ratios show us what how much liquidity does the firm have at a given point of time. So current ratio shows us that can we match our current liabilities based on the current assets that we have. Quick ratio shows us all the securities that we have that can be quickly converted into cash. So it is slightly more liquid than current ratio. Then we come to cash ratio. Cash ratio shows us the amount of cash we already have at hand, which does not require any conversion. Then we come to leverage ratios. This shows us whether we can manage our debt well or not. So the first one is debt ratio. By debt ratio, we divide the total debt by total assets to see if the assets are in case of a liquidation, can we match our total debt by liquidating our assets. Then we have debt to equity. This measures whether the company's debt is more or less than the equity that the firm has. This shows us the capital structure of the firm. And then lastly, we have the interest coverage ratio. This shows us whether the firm can cover the interest that they have taken from loans by the assets that they have. Next, we come to efficiency ratios. First one is asset turnover ratio. Asset turnover ratio shows us that are we able to cover the cost of assets by this revenue that we're making. So the formula would be net sales by average total assets. Then we have inventory turnover ratio. Inventory turnover ratio is simply whether they are able to cover the cost of goods sold by the average inventory sold. Then lastly, we have receivables turnover ratio. Receivables turnover ratio shows us whether we are able to receive all the amount that we are giving to our debtors. We have sold it to them on credit. and whether we are able to recover it well or not. Then we have our profitability ratios. The first one being gross profit ratio. It shows us the gross profit out of the total revenue you are making. It helps us analyze how much percentage of our revenue is going into the costs. Then we have operating profit ratio. Operating profit ratio is taken into consideration after taking operating expenses as well. Then we have return on assets. Return on assets simply shows us that these are the assets we have invested in. It can be a building, it can be a machinery, and this is the return that we're getting. This is the revenue we're making out of the assets that we've invested in. And lastly is the return on equity ratio. Return on equity ratio shows us that the amount of equity, the shareholders, the return that they're getting on their investment. So, with this, I think we can begin the case study. So, I'll just be sharing this Excel file with you all. If you can just give me a second. Yeah, I have shared it. Today we will be doing the case study of ITC. So I have taken, I personally use this website called Screener. So, since ITC is a publicly listed company, they are obligated to share their financial statements with the general audience. So, Screener is a third-party app that converts the reports shared by the company into a concise Excel format. So, it is a handful and it is easy to use. So, just a second, I will share my screen. Yeah. How it's done is, first, if we see, we have the profit and loss statement over here, which shows us the net profit, which shows us the gross profit. In this case, there are no operating costs. So the gross profit and your operating profit remain the same. Then there's a quarter analysis that happens, that this is from 2021 to September 23. Then we have a balance sheet over here for each year for the past 6, 7 years. And then we have a cash flow over here, that this is the cash flow of the company, and this is from the operating activities, this is from investing, and this is from financing activity. So using this, we can even identify what should be the ideal value of the business, which I will show you in some time. So we can begin with the ratios. So if are you all able to access the Excel file which I've shared? Uh, am I audible?
Yes,
Yes,
sir.
sir. Yes, sir.
Okay. So I will begin with the current ratio. So in this case, we have our current ratios in the balance sheet. So I will take, this is our current ratio, the working capital, debtors plus inventory, divided by the current liabilities. So this would be our current ratio. And in practical terms, a current ratio which is over 1 is considered good, as it shows that your current assets that you have are sufficient, to match your current liabilities. Next, we go to the quick ratio. So quick ratio is only marketable securities. So I will just show you which one apply in this. So working capital is the only in this scenario we have only this one that is applicable, as the rest would not come under working capital, would not come under quick assets, sorry. And then we would current liabilities. So as you can see in this scenario, they don't have, I mean, if they are require, if they have a financial emergency where they're expected to pay the current liabilities off immediately, it would be a slightly difficult situation for them, as they don't have enough uh, quickly convertible assets as they have otherwise. Then next we come to the leverage ratios. So we can see debt ratio first. So if we see the balance sheet again, this is the total debt that they have. That is your borrowings plus current liability, and that would be divided by your uh, total assets, which is this. So this is the debt ratio, which is again the sufficient amount. So this shows that the debt can be easily paid off in case of a debt requirement. Then next we have a debt to equity ratio.
Sir, can you repeat the current and quick ratio?
Sorry, could you please repeat that?
Can you repeat the current and quick ratio?
Current ratio?
Yeah, current and quick.
Okay, so current ratio shows us basically the liquidity that we have. So current ratios, current assets are all that will be converted into cash. So say if you have a current asset, say which is a debtor, so you know that this debtor is going to pay you whatever he is due for within the year. So ultimately you will have cash in place of this asset that you have right now. So how do we calculate it? We take the current assets and we divide them by the current liabilities. So what we want to see is that if suppose at the end of the year, if we have to pay our current liabilities off, if we have taken goods from a supplier, say on credit, and we know we have to pay them whatever the cost of it is at the end of the year, are we going to have enough cash assets that will be with us at the end of the year, which will it be sufficient to pay off the current liabilities? So how I calculated it is I simply took the balance sheet. I took working capital, debtors. Debtors are the people who are supposed to pay us, and the inventory that we have. So all this is considered current assets, as these will be converted into cash by the end of the year. So I took the sum of this and I divided by the current liabilities, which is mentioned here. So we got a ratio of 1.11, which shows that it is sufficient. I mean, if at the end of the year the firm needs to pay off all its current liabilities, they can do so by just the current assets that they have. They don't need to use their retained earnings. They don't need to use funds from anywhere else. They don't need to take a loan, etc. Uh, I hope you have understood, or do you have any further question on that?
No, sir, can you also explain quick one?
Quick
Quick.
ratio is simply it is cash plus marketable securities. So anything that I possess right now, which I can easily sell off in the market. If I have an inventory that is all raw materials, I will still take some time to sell it off because it shows 8255.24. This is actually the figures are into multiplied by crores. So this is actually 8,255 crores. So I cannot possibly sell this off even in 1 week. It will take me a quite a good period of time to be able to actually sell it off and convert it into cash. So quick ratio is something that allows us to immediately convert what we have and any asset into cash. So one asset is cash itself. I mean, it's already in the most liquid form. The second is if I'm holding any bonds, any shares of other companies. So these are all very liquid assets because, say, if I'm in an urgent need for money today, I can easily go to the market and sell these stocks. I can sell the shares, I can sell the bonds and easily get cash for that. So that is the main difference between current and quick ratio. Quick basically suggests that can it be quickly converted into cash.
Okay, sir, understood. Thank you so much.
Thank you. So then we come to the debt to equity ratio. So the debt to equity ratio takes the total debt, which is borrowings plus current liabilities, and we divide it by the total equity share capital. So here what we see is that debt is far significant more than the equity ratio that we have. It's 259 times. That shows that the company believes that using debt as a source of financing is more cheaper for them than compared to using equity. Then next we come to interest coverage ratio. So here we use the net profit after tax, which is net earnings before tax. So which we will get here. I have the net profit here, profit before tax, and then I will subtract the interest from this as well. And we will divide that by the interest to be paid, which is this value. This is the interest that they've paid in March 2014. So when I divide this, it shows me 13,050, which shows that I have significant earnings, and compared to that, I have very less interest to pay. So I can easily cover it from what I'm making in a year. I don't need to have any other source of financing in order to be able to pay my interest obligations. The next we come to the asset turnover ratio. So asset turnover ratio is nothing but your sales divided by your average total assets that you are making this much in revenue. So they want to see how much are you making use of your of the assets that you've invested in. So these are your sales, and then we divide them by the assets that is here. So this shows 0.86. So within 1 year, we are already making 0.86 use of all the assets that we have. So we are almost close to, I mean, we are 0.14% away from the break even between the assets and the revenue. Then we have inventory turnover ratio. So that is your cost of goods sold divided by, that is your cost of goods sold divided by average inventory. So what they want to see is that are you able to are you able to utilize all the inventory that you're purchasing? That if you are buying say 100 units of a raw material, are you able to actually convert it into inventory which is then ready to be sold, and so you can make revenue out of it? So we calculate it using our just a second, we have a capital, working capital. Here we have our inventory. Cost of goods sold is our expenses over here. So what we will do is we will take our cost of goods sold divided by the inventory, that is 8255. So this shows that we are able to convert it very quickly. So in a year, the inventory is converted into cost in is the raw materials are converted into inventory 2.69 times a year. So that shows that the sales that the company is making is very good, that they are able to convert their raw materials very quickly into units ready for sale. Next, we come to the profitability ratios. So first we will see the gross profit ratio. So this is your gross profit divided by total revenue. So gross profit, as you can see, is the first step of the income statement, where it shows you just the raw sales, how much we have earned, the income we have made from just selling the goods versus how much did we incur to make it. So it will be this divided by our total revenue, which is sorry, gross profit will be our gross profit divided by the total revenue we have made, which is the sales amount. That will give us 37%. So as you can see that the company is making a good profit rate, which is of 37%. Then we come to our operating profit.
Sir, I have a doubt.
Yes.
This calculation part I understood, but how will we get to know that the ratio that we have derived is the ideal one? Like this is best or this is not? Like, is there any ideal ratio, like above which we should have?
Yes, so ideally, for the liquidity ratios, there are set benchmarks. I mean, like I mentioned, for current ratio, it should be over 1, so that we know that in case of an emergency, we have enough already with us to be able to pay off what is due from us. However, for the rest over here, there is no set benchmark. It varies from industry to industry. So when every industry has its own benchmark, and ideally the way to because these factors all depend on multiple various reasons. Some can be within the companies, and some can be economic factors. So the ideal way to know whether this is a sound financial is to compare it with other companies in the same industry, see what their ratios are showing. I mean, here we don't, I mean, if you think that you have to calculate it for all, this is just to show you all how it's done. But if you see online, you will get ready, ratios for each and every company. There are a lot of websites. If you go to investing.com, if you go to Screener, then Money Control, a lot of these websites have ready fundamental for each and every company. So yeah, the right way to know whether it's a good ratio or not is to simply match it with other companies in the same industry.
Okay, sir, got it. Thank you.
Then we have our operating profit ratio. That will be our operating profit, which is again the same. So in this scenario, because there is no operating expense, we have a same percentage, which will be 37%. Then we come to our ROA, which is return on assets. So here we calculate the net income, which is after tax. So which will be this value. As we can see, we have calculated the profit before tax. This is the tax that has been paid, and this is the net profit. So our ROA will be net profit divided by the total assets. So what they want to see is, this is the assets I've invested in. This is the final profit that I'm making. Is it worth? Have I invested too much in assets that are not performing well enough for me? Or am I making good enough from what I'm investing in? So we again check that this is the total assets. So we get 22%, which considering most of the assets are going to be long-term assets, it is a good rate, because within 5 years, you will be able to cover your entire cost of investment. Then last, we come to the ROE, which is the return on equity, that for the equity shareholders, that what is the actual return that they're going to be getting. So we have the same concept. We use the net profit, which is going to tell us this is the amount we made, and this is the amount of shareholders that we have. So that would be your equity share capital, which is over here. So this gives us 11.18%. Just a second. So this is our net profit divided by our equity share capital. Yeah, that is 11.18%. So it shows that for investment, people investing into this company, they can expect an average return of 11.18%. So this is how fundamental analysis takes place. Then people assume, then they will also see the stock prices. If you see, this is the dividend payout also. Dividend payout is nothing but if say the company has made 8,000 crore rupees, if this rate was 50%, then that would mean that out of the 8,000, they are sharing 4,000 with all the shareholders, and the remaining 4,000 is reinvested into the firm for their own growth and development plans. So this has shown us this over the years uh, how they have been paying out the shareholders. So it was only 53% in March 14, but then slowly they have started increasing. And if you see, in fact, in 2021 and 2023, they have paid over what they have earned. So they have even used some of their retained earnings from the previous years, and they have given quite a good value to their shareholders back. So this is also another factor to consider before deciding which stock you want to invest in. Then we will
So
come.
why will a company pay over its revenue? Like, what is the logic behind paying extra?
So sometimes there has been the company has done very well, or they have introduced new shares. So sometimes they reissue shares, sometimes they divide shares. So then for this, because they want people to buy the shares, they also start doing this, because the more they have more shares to issue, then they start paying out more dividend, which gives an incentive to the shareholder to purchase more shares of that particular company. So the shareholders are happy because they are getting dividends, they're getting returns on their investment. At the same time, the company is also happy that they are getting more shareholders, they are getting more financing, and sometimes even the financing requirements that they have are slightly more on an urgent basis. So then that is the reason why they prefer to give uh, more than what they've earned that year.
Okay, sir.
So now we come to the last part, where I will show you how the value of the business is determined. So here we have the cash flows of various years. If you see, we have the net cash flow of March 2014, March 2015, 16, and we have it until 23. So based on this, if say we were in 2014, and I want to know, okay, that I am going to be investing in this company for the next 10 years. So from 2014 to 2023, my 10-year horizon, I want to know whether it's going to be a good investment or not. Am I going to make money out of this? So how we can manage this is, first we have to find out the expected cash flows of each year. So assuming we are in this year, so then all these values become my expected cash flows, that this is the amount I'm going to earn after each year. So this is also done by companies before they want to invest in a particular project, that they analyze that, okay, these are the investments I'm going to make over the years, then these are the returns am I going to get. Now is it going to be a beneficial investment for me, or is this not going to give me any returns? So we have a concept called net present value, which we are going to use here, which I'm sure some of you must be considering to pursue CFA at some point of time. So this is one of the first topics that will be taught to you, which is basically we determine that, okay, it's 2015 93, but what is the value of this money today? Because it takes into consideration inflation, it takes into consideration that 93 next year does not necessarily mean 93 today. It will include your rate of inflation, what is the interest rate going on in the market, which is also called the discount rate. So the simple formula for that is we take the cash flow, and then we divide it by 1 plus r, and this we divide it by we raise it to the power of the year we are in. So in this case we're in the first year, so it will be to the power of 1. So if I want to calculate it, I will take this divided by 1 plus, and say for this we assume a discount rate of say 15%, that every year we expect that uh, whatever we have, even by standard bank deposits, we will earn 15%. Again, this is a very hypothetical number. So we take this, we divide it by 1 plus 15%, and we raise it to the power of 1. So this will give us that, okay, that this is March 14 at the end of the year. This is what I'm going to get at the beginning of the year. This is what the 32 is worth to me right now. Then we do the same thing over here. Just a second. So here we have taken 93.26, and because it's the second year, we take it to the power of 2. So we get uh 70.52. If you notice, because it's further down the years, the value of it will always reduce. And the further it is, the value of it reduces further, because if I have say 100 rupees today, doesn't mean that those 100 rupees will remain 100 rupees after 2 years. It will become 200 rupees maybe. But after 5 years, that might become 500 also, because even if I put it in a bank, the bank will give me interest for that time. And the longer I hold it for, the naturally the more I will earn on that money. So if we keep doing this till the end, just so if you see, we have the expected cash flow from each year in today's values. So now simply we will sum it up, and this is the value that we get, that this is the present value. And there is also, if anyone is wanting to know a shorter way of probably doing it on Excel, there is a feature called NPV over here, which shows returns the net present value of an investment based on a discount rate and a series of future payments and income. So if we take this, we will take the rate as it is, 15%, and then simply value 1, value 2.
So can you repeat that? I missed it.
Sure. Which part?
The shortcut method that you just told
Okay.
me.
So here, I'm sorry, could you please mention your name to me? I did not get who spoke.
Priyanka.
Priyanka, right. So Priyanka, did you get this first calculation that I explained, how we
Yeah, the
got?
formula part I understood, but I didn't get the 137.97. What is that amount?
Okay, so as I mentioned earlier, we are in March 2014. So I want to know that at the end of my 10-year horizon, which is in 2023, am I going to be making a profit out of this plan that I have, or am I not going to make? So if say I'm planning to invest in this company, say ITC Limited, as we have the fundamentals over here. I am in 2014 right now. I am thinking that I want to park a lot of my money in ITC for a 10-year period. I don't want to have the stress of, taking it out, reinvesting it somewhere else. I want to safely keep it there, and I want to, so I will check if I'm going to make money out of this. So now I have a team of analysts who are able to find out the future cash flow projections for me, that okay, over the next 10 years, this is the amounts that the company is going to make. So in the first year, they are going to have a total outflow, that they are not going to earn as much as they've spent, because they're still in that investing phase. uh, then in the next year also, they're going to have an outflow which is going to be even larger. But in 2016 they will make some money, in 17 they will make some money, in 18 they will make 18 again, they will lose some money, 19 they will make some more money, and then so on. So overall, what I have done is, I have seen that okay, if I were to invest in it today, and I'm going to, if all the future cash flows that I'm going to, if the company was going to get, if there was to be an amount, that how much is it worth today, the whole amount, if I, because I have to make the decision today, right, whether I want to invest in this stock or not. So I have taken this formula, which will give me what the present value of of this amount is, because of this is a value in the future year. This is not a present value. So this is
So
the
the denominator is in, like, there is one, right? Like to the power one. And then next
yeah,
year it is power two.
yes, power 2. So as the year keeps going on, we increase the power, because like the example I gave earlier, if you have if I give you 100 rupees today to invest in the bank, after 1 year you may, if they're giving an interest of 10%, you may make 110 rupees out of it. But if I give it to you for 4 years, then you will make much more, right? You will make over 150 rupees. So that's how the logic works. That is why the power changes with each and every passing year. And then at the end, what I simply did is I summed all the values. That what is the net of all the values? Am I so 137? I got my answers 137.97. And when the value of the net, when this final net present value is a positive number, that shows that at the end of that 10-year horizon, I am definitely going to make some money out of this. So if I'm deciding whether to invest or not in this, at the after this calculation, I can say that yes, it is a profitable investment that I will make today if I'm looking for the 10-year horizon.
So the sum of what? The all
The sum
the
of all the cash flows, yes.
okay, okay. Yeah,
So
got
if
it.
you see, it's 137.97. And this is a shortcut of it. There's a Excel formula called net present value itself. So in that, you're expected to give the rate first, which, as I have mentioned here, is 15%. And then I've simply inputted all the values, all the cash flows. So if you don't want to manually make each and every formula, then this is the way we usually find out the net present value even for our work and stuff. So as you can see, the same answer, but this is just a way to explain it to you all, and this is the way if you want you want the solution a bit quicker.
Got it,
So
sir.
this is only one way of valuing a company.
This is one of the most commonly used ways of valuing the company. And then as and when you go more into detail, I mean the level of detailing in the statements also increases. Based on that, your calculation method will also change. But this is one way, I mean, this is one way that you can easily find out whether it's a good investment or not. And this basically shows us that in the next 10 years, this is today, looking at it today, this is the value of the business. So if I want to know the value of a share, I will simply take the number of shares and divide it by the total. This you can also call is the real value of the business. So if say today, if you see the statement and if they show that the real value of my business, yeah, yeah. So if they say that our value is 150 crores, sorry, 150,000 crores, and here it's 137,000 crores. So that the value that they're showing right now of the company is inflated. It's not the right value. So that ultimately there will be a decrease in price, and a lot of people take advantage of this. If they believe that their projections are right, then what they would do is, because the value is inflated right now, they will sell the share right now. They will basically take a short position, and then once the value of the company starts to meet the projected value, the share price automatically falls down, and then that is the time when they square off their trade. So that is how a lot of people also make money using this method. So, does anyone have any doubt in this? I'm assuming no, so I'll continue with. So yeah, now we come to the Q&A question. If anyone has any questions they would like to ask, you can put it in the chat as well. If no doubts, then I think we are done with today's session. And if anyone wants to ask anything, please feel free to contact me. I've given my mobile number and I've given my email as well. So if you want to ask anything, maybe apart from this course also, please feel free. I was also in your college, so I understand which state you guys are in right now. And after your third year, you will also be looking for a lot of options, what to do. So if you have anything you want any help on, please feel free. You can anytime reach out to me. And thank you guys for attending today's session. And yes.
Sir,
Thank you,
I had a
Shubham.
question.
Yeah.
Yes.
Sir, in the ITC slides, in the PNL or I guess in the balance sheet, there were three columns heading with trailing best case and worst case. So what were the columns? If you can please explain them.
Let me open it. Just give me a second.
Like the best and the worst cases were regarding the years or something else.
Just give me a second. Are you able to see my screen?
No, sir.
How about now?
Yes, sir, visible.
Yeah. So you are talking about this, right?
Yeah, sir. Trailing best case and worst case.
Yeah. So trailing is basically what they feel that is going to happen in the future. So as you can see, this is till March 23. So this is their assumption of what the projections are looking for March 24. Uh, and then best case, worst case is that they have a slide because again it's a projection, so they don't want to give a very specific number. So then best case, worst case scenario gives us that. Sorry, trailing. I'm sorry, trailing is nothing but if I go to quarters here, so there we have March 23, which is the closing period, but because there have been quarters that have passed, they have September, June and September both that they have already accounted for. So trailing is nothing but what it is going at right now based on the close of the last quarter. So that is this value.
Sir, I didn't get it. What did you say about September and June? Like,
Okay, so
So, sir,
here,
trailing is this year's balance.
yeah. So if you basically see here, throughout we've had yearly figures, right? From each year, March, which is the close of the year. This tab over here has the reports given on a every quarter basis. So if you see December, March, June, and then this is March 23 was the close of the year, which is also mentioned here. Now, at the beginning from this year, which is April 23 to March 24, we've had 2 quarters already completed. 8 months have already gone. So 2 quarters have already completed. The first quarter ended in June 23. So this so when they have mentioned trailing here, they basically want to show that this is where the company is at right now at the end of 2 quarters. And then best case, worst case scenario is that based on these 2 quarters, this is where the company can head to in the best case scenario. And if it doesn't work that way, that this is the worst that the company will go to. So based
Like
on
they
what.
have themselves set an upper limit and lower limit for the companies.
Yes, correct. That they want to again, right? If you are releasing your fundamentals online, you want people to invest in your company. You want people to come towards your company. So then this is why they give it that okay, best case we will make this much, but worst case also we are going to make 76. So We were at 70 at the end of the last year. Worst case, also, we will still make money. So it's kind of giving a guarantee, giving some sort of assurance to the customers, to your shareholders, that we will do well this year also. It's not, you don't have to worry about the company making a loss.
So the trailing column is basically related to the quarters, and best case and worst case is yearly, right?
Yes.
Okay.
Then I think I saw one more question on the chat. I think Kavita had asked me, based on the value 137.97, how did you come to the conclusion that it is a profitable business? So, Kavita, the answer for that is, if I know that it's not going to make me money, then my net present value would have been a negative value. So, say if I change certain values, if I uh, make this, say, okay, it's formulated, just a second. If say this value were to be, instead of 174, say it was minus 79, because as you can see that there have been a lot of outflows. So if at the end of it my outflows would have been more than my inflows, then my net present value would have been a negative value. And if it's a negative value, it will mean that ultimately I'll be ending up paying more than what I'll be getting. Since the net present value is a positive value, it shows that at the end of it, how much ever I'm in paying, how much of investment I'm making, I will be making money out of this. I hope
Okay, so
that
how,
answers your question. Yeah.
Thank you.
Yeah, 15% is our expected return, which is also called the discounting rate. And this 15% is just a standard assumption I've taken. It is a hypothetical value. It can be 10% also, it can be 5% also. But if I change this to say 5%, so this is the profitability of the company right now. If I say change it to 5%, it further increases, because then the expected rate is itself lower. So, rate plays a big important factor in this, because based on the rate that you're getting, your investment decisions can also change. Do we have any further questions? I think Mahek's answer was already answered. Do we?
So regarding the same question, the 137.97 value, you said if
Yes,
it's in minus, then there'll be no benefit for us, so no point
correct.
in investing. But how to decide if it's enough, or like if it's a really good option to invest? Like,
So ideally, when this is done, usually there is a team that decides that, okay, this is the expected return that we're looking for, and they have their set parameters that, okay, this is the kind of return we're looking for. So when this is calculated, if it matches, sometimes what happens is, you have, this is one stock, right? So usually what happens is there are 10 stocks that are taken into consideration, and the net present value for each stock is then derived from their future projections and cash flows. So then based on that, they are able to then get a comparative analysis, that, okay, this say ITC is giving me 137.97, but say if I take Reliance is giving me 145, Tata is giving me 165. So then based on that, I already know, okay, that this company is giving me a very good return at the end of, this time horizon that I have.
okay, so there's no such range of like the value. It depends on the company basically.
Yes, it depends on which industry you're looking at, because some industries don't have a very high growth rate. Like if you see steel industries and all, they grow, but the rate of growth is not that high because it is a very capital intensive business. Whereas somewhere, say an IT firm, for example, Zoom, the platform that were on, the way the company rose during COVID, it was substantial, which, no, in no scenario can a steel company or say such a big capital intensive company grow. So it again depends from industry to industry.
Got it, sir.
Yeah. Oh. So, can you recommend any book or website that can help us level up our knowledge of these financial terms? So, there are a lot of, I mean, now there are a lot of resources available on YouTube as well. There are many people who are explaining concepts very well. Then there is terms like investing.com again, which is one site which you can use to even see reports. And yeah, so if you just search, even on Google now, that I want to learn this term. Now we have AI as well. We have Chat GPT. We have multiple AI. So if you use any of the resources, I mean, at least to set your base level, you can get all the information easily available online. Yeah. Dave, what other factors to look than this ratio of fundamental analysis, right? So just I'm assuming you all know that fundamental analysis is usually looked over by analysts who are looking to trade maybe the stock for a long period of time. People who want to do intraday trading, or maybe for a week if they want to quickly buy and sell, then technical analysis is the main reference point for them. In fundamental analysis, one is we look at all these financial statements. They are studied over a good period of time in detail. Apart from that, what we look at is the qualitative details as well. We look at what the company's reputation in the market is. If you see ITC, it is a FMC. If it's mainly into FMCG, and it holds the largest share in India right now. So you know that okay, ITC is a very well reputed company. So you don't have to worry about, oh, suddenly one day you will wake up and you will hear that ITC is shutting down. No, that will in 99% scenarios not happen. So that holds a very important value. You know that they have the most competitive products going around because they have the highest market share. They have a very good goodwill value as well. So these are the things you see. Also, you see that uh, you see the economic factors going around in the country. As we know, ITC, one of the things that ITC, the only bad part that people link with ITC is its production of cigarettes. So, say tomorrow the government brings out a rule that cigarettes are banned. No one is allowed to buy, no one is allowed to produce, no one is allowed to sell. So naturally, it will impact ITC's business a lot, because then these are the factors that they also consider, that what are the percentage chances that okay, cigarettes may be banned. I don't know if you're following, but some countries have already started with their implementation of increasing the age gap, minimum age requirement for consuming cigarettes. I think New Zealand was the first country to do that. So say if that same thing happens in India, that if they start increasing it by every year, so then naturally the production will reduce, because after a certain point of time you won't have that population who will actually consume the product. So these are the other factors that fundamental analysts usually look at. Statements are the main thing. After that, they look at the qualitative factors, and then they look at the economic and industrial related factors. Does anyone have any other doubts or anything they want to ask? Even Canada has started printing health warning. Yes, yes, correct. Yes, Sejal. So do factor factors of analysis change from industry to industry? Yes, they can change. I mean, certain because see, if you see again electricity, so there is not much, I mean, competition in India, because you have mainly Reliance, you have mainly Adani who are providing electricity in India. Especially, I'm not very sure about the whole of the country, but in Mumbai, that is the scenario. However, in another industry, if you take say cars, there is a much more higher competition factor that is involved in that. So that way, yes, factors do change from industry to industry, but what people usually do is that they take all the important metrics from companies in the same industry. Aman, looking at the statement and financial of ITC and valuing the cash flow, does it become viable to be included in a portfolio? So, are you asking me if you should buy this stock, Aman? See, you have to also, I mean, depends on which horizon you're looking for. This may be a good option, going forward in the long term. Short term, I cannot comment much on this because I have not followed this stock for long enough. And yeah, so I think the best is you should look once at by own about the technical side of it as well as the fundamental side. Dhruv, you assumed we are in 2014 and doing future analysis, but how can I do this now for future analysis? We don't have the statements. Right. So, if you search online, you will find maybe not for 10 years. In this case, this is a very theoretical and hypothetical scenario that was there because it was just to show the concept. But if you see online, you will find a lot of companies have their future projections as well, that these are our future projections going forward. And based on that, they have their assumptions and we take those values. Obviously, those values are not very accurate. In our case, because we assumed we are in 2014, so we already had the fundamentals for 2023. So if you want to do this, maybe you can do this as a trial. You can see the company. If you go to any company's website, they will have a section called investor relations where they provide all the fundamentals that we saw today. They have the balance sheet there, they have the income statements, they have the cash flows. So that is the way. If you want to check for maybe some future analysis, you can see the future projected statements, and based on that, you can try to get the net present value today. This shares a good avenue if you wish to keep the period as 5-7 years. Yes, Rishita, it's always a good avenue, but here the catch is that shares also has a big downside. So first of all, you should have that appetite for risk, and second of all, if you're investing in 5-7 years, 5-7 years is quite a good time for a lot of things to change around you. So you have to ensure that the company that you're investing in, you are sure that maybe it's a very big company. Say it's a company like ITC, Reliance, Tata, that okay, next 5 years they will grow. If not, I mean, you don't see them going out of competition, you don't see them exiting the market. But if you're investing in a small firm, the next 5 years can be a make or break for that company. You might end up getting 3 times your investment, you might end up losing all your investment as well. So, yes, 5-7 years, but you have to take these factors into consideration before investing. Yeah.
Sir, I had a question.
Yes, this is Bhomik, right?
Yes, yes. So, sir, you told that ITC is providing an ROE of 11%. Does it depends a lot? Means ROE is a certain thing that we should depend on. Ki return on equity is 11%. Is it good or bad?
So there is no exact parameter that okay 11% is a good value or 12% is a good value. It's very industry specific. So the ideal way is if the ITC is FMCG, so I will search up other FMCG products companies. I will see okay that this is the rate of return they're giving to me as a shareholder, and basis on that I will be able to identify if that's a good value or not.
Okay, sir. Thank you.
Yeah. Yeah, any more questions does anyone have? Just now looked at shareholding pattern majorly bought by. Yeah, nice Aman. Yes. One great shock by any government or ecological reason that could wipe out the money from ITC. Yes, so I had just given one example. Say if the government for some reason suddenly comes up and says that guys, cigarettes are going to be banned from this date. because of ESG reasons. We need to be more cautious towards global warming. We need to be more cautious towards pollution. So cigarettes are banned. Now, if ITC is a big producer of cigarettes, so of course it basically tanks half the business. And it's not just, the revenue. It's that they would have already invested a lot, in machines, for production. And so this is one example. Can can ROE be influenced by providing more dividend, as ROE formula consists of reserve fund? Yes, ROE can be influenced by paying more dividend for sure, because ultimately that is what, the ROE concept is defined as, that if I'm a shareholder, I want to see, okay, if I'm buying 10 shares, what is the return I am getting? So if my equity, ultimately, because I'm paying out more dividends, the reserve that I have, which comes under equity, it reduces. So that increases my return on equity, because that's what they want to show, that if you are investing 100 rupees with us, we are going to give you 115 back. So it'll be 15 back. You won't get your principal back, but 15 is the dividends that we'll pay. So then your ROE becomes 15%. Peers recognition competition to ensure. Yes, Aman, your question is peers recognition and competition to and shareholding to determine a view upon investing in any company. Yes, ideally, whenever you're starting out, you should always have you should have always have a comparative analysis between, if you say want to invest in ITC, just go on the internet, have a look at who are the competitors of ITC. Then you can see, at a glance, what their fundamentals are, what their ratios are. And then you will get an idea that is this company doing better, which company is doing better. Because sometimes you will see, if say the ratio of this is 1, but if you see another company and that is 3, so then you know that, okay, ITC might not be doing as well as I thought it would be. Oh, I thought it's 1, but you see the other companies are all doing 2.5, 3. So their fundamentals are much better. So maybe then ITC is not the best option to invest in. Does anyone have any other question? If you guys can always come back to me also later on. Doesn't need to be if you don't have anything now. Uh, okay, with that, I think we come to an end.
Yeah, I would request Jay Radhe to formally pose a vote of thanks. Jay, you there?
Yes, ma'am. On behalf of the BFM committee, I would like to formally thank Mr. Shubham Sanghvi for conducting this highly insightful and informative session. Our students gained a lot of knowledge on the subject of fundamental analysis, which will surely be beneficial to us and boost our understanding of stock market. I would like to thank our esteemed principal, Dr. Pooja Ramchandani ma'am, for encouraging us and inspiring us and giving us the opportunity to materialize this event into a reality. I would also like to thank our teachers in charge, Shweta ma'am and Vicky sir, for their guidance and support in organizing and conducting this course. Lastly, I would like to thank all the participants for attending today's session.
Thank you so much, Jairadi.
Thanks, Shubham. So, hoping for more such sessions. It was a great
Thank you,
session.
ma'am. Sure, sure. I really enjoyed taking this session today, and I would be more than happy to take any further sessions if required.
Great, great. We will
Thank you.
definitely connect with you again for more of such
Yes,
sessions.
ma'am. Thank
Thank
you.
you so
Thank you
much.
so much for inviting me today.
Yeah.
Thank
Bye.
you. I
Thank you
hope
so
everyone
much.
had something to learn at least from this session. Thank you,
Yes.
everyone.
Yes, sir. Thank you.
Okay, Karishma, you would like to take for
Yes, ma'am.
Everyone, please wait. We are having a quiz now. No one will leave the session. We have conducted the quiz that is very basic, and we are here to test your knowledge. What do you know about the markets in a journal knowledge? Basically, you can say the GK knowledge of your finance. So I will be sharing the link in the chat box. Please look into that. And after you attempt the quiz, we will have the results, and Shweta ma'am will announce the winners. Okay, I'm sharing the link, just a second.